Good evening, ladies and gentlemen. On the behalf of Arians Capital Markets and Merlin Capital Advisors, we welcome you to the earnings conference call of Simplex Castings Limited. From the management present on the call, we have Mr. Ketan Shah, promoter and chairman of Simplex, and Mr. Avinash Hariono, Chief Financial Officer. We must remind you that the discussion on today's call may include certain forward-looking statements and be viewed in conjunction with the risk that the company faces. Over to you, Mr. Ketan, for your opening remarks and Mr. Avinash for financial highlights, followed by a Q&A with our investors. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining us for Simplex Q3 FY2026 earnings call. We entered the second half of FY2026 with strong business visibility, a diversified order pipeline, and a clear strategic momentum across all our key verticals. The company has delivered a solid performance over the last 9 months of this year, driven by very good demand across our traditional sectors like steel, railway, EPC, and we have also entered the defense sector in a very small way. While the third quarter saw relatively moderate revenue growth and margins more flat, we would like to emphasize that this was not demand-led. The quarter was driven by a conscious effort from us, basically to take strategic initiative on capacity readiness, internal process cleansing, and preparatory work for scaling our railway and other areas of working. So that in future, these are more, it will contribute to our performance in the coming periods. That being said, we remain confident of achieving our stated guidelines that we had given earlier. Overall, if we look at our performance, it's compared to past year, it is much better. Execution momentum that has remained consistent and strong, and we have taken our best efforts to announce on the exchange as and when they occur. Our current quarterly order book is above 100 crores, providing healthy revenue visibility. During the quarter, we have received high-valued orders and some trial orders from companies, marquee customers of ours like BHEL, Mazgaon Dock, Gaza Engineering, and others, which highlight our technical capabilities and customer positioning across complex engineering segments. A key milestone during this quarter was successful completion of 50.15 crores fundraise, which enables us to re-enter and scale up our legacy on the railway bogies business, both fabricated and casted. The proceeds from this issue will be utilized in a structured manner. About 50% will be allocated towards capital expenses for expansion of sheds and fabrication facilities and for the railway bogies, and the balance 50% towards incremental working capital requirements which are required looking at the increased turnover that we are expecting. This enables us to restate and scale the business with the right capacity, processes, and cost structure in place. Looking ahead, and supported by operating leverage, execution normalization, and strong order pipeline, our long-term vision has been consistently shared with our investors, and we continue to execute on it with discipline, prudence, and clear focus on value creation. For the financial part, I would request Mr. Avinash to give a few.
Avinash, you'll have to unmute yourself.
Am I audible right now?
Okay. Yes.
Along with the growth initiatives, we have closed the 9 monthly figures as around 150 crores and with the bottom line of 15 crores, which was the last year's profit. We remain firmly focused on financial discipline and cash flow strengthening. We have begun working on deleveraging balance sheets, tightening working capital management, and faster receivable realization. Our empanelment with the RXIL platforms, InvoiceSmart platforms, under the Trades platform is an important step in this direction, allowing us to improve cash flow conversion in the lower cost of funds without incremental leverages.
Okay, with this, I will open the floor for Q&A for any investors who want to ask any questions. Please note, while asking, first raise your hand, and second, when you get a chance, please introduce yourself and the firm that you represent. So using the raise hand feature, I think we can start with the Q&A. Participants who want to ask a question may raise your hand. We'll wait for a minute for the queue to line up and then we'll start with the Q&A. We'll take the first question from Mr. Bhavin Dedia.
Yeah. Hi, sir. Good afternoon.
Good afternoon, Bhavin.
Congratulations on a decent set of numbers. So just wanted to color on your order book breakup, if you could provide of 100 crores. And also, if you can throw some light on the new order wins from Mazdao Dock and Gaza Engineering. So what kind of orders are they? Are they defense orders or is it for the shipbuilding castings that we have?
If I have to break it up broadly, in the steel plant is still the major contributor. It's about almost close to 50% is steel plant booking that we have, and a good 30%, including Gaza Engineering, is from the fabrication side of power industry. We are doing equipments and other fabricated structures for BHL, and Gaza is also in line with that area. And rest 20%, I would say, is all distributed between gearbox manufacturers to pump manufacturers to machine tool industry. Mazdao Dock was something shipbuilding which will be seeing more of it in the shipbuilding industry. This was a restart of an old thing that we were doing, old order, and this is about 5 to 6%.
Okay, so this is not defense related.
It is for the naval ship.
It is for the naval ship. Okay.
Yes. See, if you look at any of the shipyards, the maximum work that they're doing is for Indian Coast Guard and Navy.
Okay. Okay. So our railway orders have still not started coming in. The
No, we got a trial order, as we have told you. We have told you about the fabricated bogies, the trial order that we have. Percentage, it might not look nice, but it's a trial order, so the quantities are less. And that is on the first and the second, two types of bogies we already going in for trials. Railways, on the casted bogie, the investment that we have done earlier, that should also bring fruit now, because the final signature from RDSO, that is all that is what we are waiting for. Rest, everything is done. Assessment and everything is done. We're just waiting for the clearance from them so that we can go ahead and start booking orders for the casted bogies also. The casted freight bogies.
Okay, so that will come in FY27, the casted ones.
26, 27, yes.
Okay. And so my understanding was the steel plant, you already have 50% order book from the steel industry. But as you were mentioning that a lot of the steel companies have already have announced a lot of capex for facilities, and they were into the designing stage currently. So those orders should start flowing in by end of this quarter or start of next quarter, or will it take some more time?
You'll be happy to know, because this is we are talking about the first 9 months. We have already booked an order. I told you last time that the most of the capex, that have been decided, especially PSUs, to OEM. OEM will go into design phase and start ordering. So the first order of about 12.71, about 13 odd crores for one of the steel plants, public sector sales steel plants, through ThyssenKrupp, we just got it in this month.
Okay.
So that process has started, sir. And I think we should be announcing very soon the others that are in pipeline very soon.
Okay.
So once their engineering is over, they go for procurement, and this is the right time. 26, 27 I expect that, we should be, the amount of offers that we have submitted, even if I take 20-30%, it is sizable business that will come from OEMs for the PSUs and the other plants.
So one more, so I noticed that our EBITDA margins were a bit soft this quarter, but the PAT margins were maintained at 10%. So that there's an other income of 1.6 crores during this quarter, and it's other normal income. So can we expect to, so what is the other income, and can we expect it to be recurring going ahead?
No, that is not. That is not of a recurring nature, sir. That that was an income from gratuity fund. So this is one-time arrangement only.
But the margins slightly have been lower because of the product mix. But in this quarter, at least I expect the margins to get back to where they were.
And we were talking about improvement as well.
Yes.
Yeah.
This will 26, 27 with a little bit of choosy. That the moment we get everything operational and we become a little choosy, I am 100% sure that the margins, the trajectory of the margins also will improve.
Okay.
See, railways, I'm expecting good, better margins. Once the casted bogies that they start, again the margin improvement would be there. There is a sufficient scope and improvement of margin there also.
Okay. So just one thing from my end, can you throw some light how Q4 is? We are halfway through Q4 right now, and what will be what is the momentum of order execution in Q4 as well as Q1 of the coming year? If you can throw some light.
Avinash.
It will be better than last year's final quarter, sir. We are geared up, and we hope so. And it will remain.
We are working.
Yes, we are working on it, sir.
Okay, sir. I'll fall back in queue.
Thank you.
Yeah, thank you. Next question we'll take from Mr. Praneeth. Praneeth, you can ask your question.
Yeah, thank you for the opportunity. So first, I'm new to the company, this disclaimer. So I just wanted to understand, in 2018-2019, we had a revenue of 220-230 odd crores. Could you explain how has the product mix changed and why is it so over now, and why are the revenues different? Did the revenue scale back?
In 2018-19, sir, we had one of the railway dedicated unit at Urla, which was continuously doing railway products and some of the high-end products like Transom, we were exporting to GE and EMD at that moment. So that was the reason why the top line has declined. We had to hive off in 2019 that unit, which was continuously doing railway business.
But why did the company have to hive off that particular business?
Because of some banking challenges, sir. We got the sanction, but the disbursement couldn't take place throughout the year.
And this was the capex or working capital?
Working capital. We were geared up having 300 odd crores of orders in hand, so we had started working on it. But we could not get the enhanced working capital limits at that moment of time.
But do you expect such problems to come in the future also? I understand we need a fundraise, but what is going to be different from that time?
Not with this type of situation, sir, where all the sectors are booming and we are having your support also.
Apart from that,
not relying on the banking channels right now, so we don't expect any.
The freight wagon bogies, the casted bogies that we talked about, we have already set up the line here also, and that is something that we were doing there for last 15-17 years till 2019. So we'll be restarting that back in our unit here, and that should be adding at least 40-50 crores on the top line.
Okay, so you expect to restart that particular division?
We have taken whatever investment was to be done. That's already done. It's completed. First and second phase of RDSO that is also over. They come there for an approval of facilities. Once they approve it, I'm only waiting for the signature, as I told you earlier. Once it is signed, then we can go and start getting orders.
Understood. So, and that particular division is that plant sold off, or was it different?
Yes, sir. we gave it to Texmaco, who was one of our customers. It was just 20-25 kilometers from here, and that top line there we used to be making anything between 110 to 130 crores.
Understood. But going forward, you don't expect any working capital challenges at this point?
We have done very well in the last 3 years, 5 years, and the whole focus has been to never get into the same situation again.
Understood. And was there a strategic change of product mix as a result, or do you think because the overall dynamics of the industry changed, is it going to get better?
Both, sir. What we are looking and what we were doing is much different, and we have to keep reinventing because we are into contractual manufacturing. So we need to go up the value chain, which is a constant pressure on us. And for that, the capex that we are suggesting is only for that, so that we keep moving up the value chain. So whether we like it or not, this is the kind of business, and we have to move. And at the moment, all the key verticals are doing very well. All the key verticals, and the visibility for the next 4 to 5 months, 4 to 5 years seems to be very, very good. Whether I look at steel, whether I look at railways, whether I look at power sector, whether I look at machine tool, whether I look at defense. See, you have a company, a manufacturing facility, which is very, very suitable for customized making of equipment. So we have very, very flexible. We have number of machine tools, a lot of CNC machine tools, a lot of conventional machine tools, and all of them are big and flexible. So that is why we are able to cater to this wide range of industries, which we were doing earlier also. But we are moving up the chain. Whether it is defense, we have been doing things. We are moving up the chain. Whether it's railways, we are doing things, but we are moving up the chain.
If you don't mind, could you give examples of what exactly you mean up the chain? What was we just
up the chain? Say, for example, in steel plants, if I start, we were giving sinter car assemblies. So from sinter cars and pellet cars assemblies, we started giving other items also, other associated, the sprockets, the turning system, the guiding system, and all those kind of things, which was being imported. So we got into that. So everywhere, like machine tools, we were giving only as cast castings. Now with we have been able to give completely machined casting from us. Well, castings also, we are giving totally machined castings now. Soon we will be doing some assembly for some of one or two of our customers.
And is this measured to specifically grow revenues or product margins, or is it both?
Both. It differentiates us. See, first of all, when you look at a foundry, having these kind of machine tools and these kind of CNC machine tools available with them, that also differentiates. Now you look at it a little more deeper. Now I am also having a fabrication shop. I have got an assembly shop. I can make equipment. So I'm able to assemble and give him sub-assemblies or even complete product. So it differentiates me further. Each and every level that we add, we become less of a foundry, more of a solution to the customer.
Understood. And so do you see a large growth opportunity in exports compared to domestically, or is exports not a suitable avenue for such large castings?
So we have been consistently exporting for the last 3 years. But mostly the policy of Simplex has been very simple. Export the items which you have a proven track record in India. So what we have done is we have exported a lot of steel plant equipment and railway, because these were the two major items that we were making. Other than that, we did a lot of pumps and valves. So opportunity wise, consistently, many years, over years, it was anything between 20 to 30% of our revenues was from exports. Now steel plant world over has died out. It's only domestically where it is growing. So I'm not expecting too much other than from Russia and Ukraine. So there it will go. Railways, we were out in 2019. We are going back. So I'm expecting that to also grow.
Understood. And Russia and Ukraine, because there's been a lot of activity in this steel plants.
So because basically, if you look at the kind of steel plants that we have, it's Bhilai, where we are based, or Bokaro, these are all Russian design. So we are very familiar with the kind of equipment that they make, and we are doing that consistently for the Indian steel plants. So the moment the war is over in Russia and Ukraine, they go back on the verge of becoming normal again. So those were the first things that they'll be ordering. And just before the war started, we had orders worth about 23 or 24 crores from Ukraine.
Okay.
So we have a presence there. Presence is just the people know us in Ukraine and in Russian steel plants. And we are very confident that these two areas will be like India and China and would go for integrated steel plants, the way it's in India. Rest would be a different. I mean, if you look at the Western world, there will be a different kind of steel making compared to India, China, and Russia.
So for the Russian designs, did we have a technical tie-up previously, or was it just us renovating slowly later?
No, it's always custom built. The designs have come to the steel plants from the Russians, and the steel plants are ordering from us.
So basically, a Russian consultancy gave the designs to the domestic steel foundry, and the designs were given to you.
Absolutely. I mean, if you look at Bokaro, it was under collaboration with the Russian government, Russian companies. But it's similar.
So understood. So steel making is still a huge industry in Russia and Ukraine at this point of time, and you expect it to pick up as soon as the war subsides or whatever happens.
And very similar to Indian kind of steel making, and those are the equipments that we make.
Got it. So as I understand, steel making for Russia and Ukraine is going to be, the green shoot will be the war ending, and for railways already it slowly, as the production comes back on capacity, it will grow. But what are the other particular verticals you see in terms of growing substantially? Because I understand that your cash
for exports or for Indian market, sir?
Indian domestic market.
Domestic market, I have seen a tremendous growth in power sector, which I see consistently for the next 4 to 5 years. We have been the best supplier in 99 and 2003 for BHEL, Hyderabad. And unfortunately, India had not gone in for too much of coal-based power, thermal-based power plant. Now, again, there's a huge load on BHEL and L&T. Both of these companies we are working with, and it is on fabricated equipments, castings, pump castings, fabricated pumps, fabricated, separator bodies, and for the mill, for the coal pulverizing mill, various things, and including the structures. This business, if value turns me, it is so huge that there is, if we scale up, which we will be slowly, but there is no limit to the scale up that is possible in the power sector also.
Is it because we need a lot more plants? That's the reason there's so much scale up, or what is the reason specifically?
It's basically too many plants have been ordered. Adani has ordered 16 thermal power plants.
Okay.
NTPC has ordered 22, and adding to it, some state electricity boards have also gone in and ordered. They want to get these commissioned by 2030, because after 2030, the decision is there that there will be no more thermal power plants in India.
Okay.
So for the next 6 years, it's a huge market. Each thermal power plant can keep us busy for our work, only for our work, for all the 4 years, and there are so many.
So one power plant is enough for keeping us busy for that, taking our capacity for 4 years, basically.
Then also we won't be in a position to do everything, because in a power plant, normally if you look at the fabricated component, it's about 5 lakh tons. And the capacity that we are building now would be about 1,000 odd tons a month. So it's 12,000 tons. So 4 years, 5 years is 45,000, and each power plant would need 5 lakhs to 6 lakh tons of structures.
5 lakhs of structures.
Yeah, and leaving aside the equipment also.
So how is it serviced right now at this point of time in the country? Is it all imported?
It is at the moment. There are plenty of people who are working with BHEL and L&T like us, but there has been some request from Power Ministry to PMO that please allow the Chinese, because the sufficient capacity is not available in India. I am very hopeful that it will be turned down because that goes against the basic principle of Mr. Modi of Make in India.
But how? So, okay, I understand philosophically that we do not want Chinese, but apart from that, despite Chinese coming in, we'll still have plenty of demand left over for us, right?
Yes. Yes.
So why, just one last question regarding why are we not being more aggressive in terms of adding capacity then? Is it because of the teething issues we'll have for starting back?
No, it's at the moment we are going ahead and adding capacity in the fabrication unit we have, and then we are looking at other areas also. Like, we have an offer from ArcelorMittal Nippon Steel. They are putting up a steel plant in Visakhapatnam that for 4 years, 5 years, whatever you make, whatever fabrication and equipment that you make, we'll buy. Only thing is we are still considering that whether we should be having a unit in Visakhapatnam next to them, next to where the plant is coming. So that is an area that we feel we'll be more comfortable, if there's a buyback arrangement for 5 years. So that is also we are seriously considering.
What could be the factors that could be hindering us from putting up a plant? Is it just the capital requirements?
Sir, no, actually, not only that, we need to understand that how it's to be managed. The management bandwidth should be there and the financial bandwidth should be there. Capability and capacity can be added anytime. I mean, it'll take us maybe about 6 months to 1 year to get it operational. And the customer is saying that they will have some clause where, if they are not able to give orders also, then they will pay us. All those clauses kind of, they're inviting us there. So we are considering that very seriously, sir.
So in terms of transportability of these large castings.
Praneeth, I'm so sorry. We'll give other investors a chance to ask a question.
Just this last question, sorry. The transportability of these castings, is it possible, let's say, if Mittal was willing to take our, let's say, our capacities from our existing units, is it possible to transport these large castings there or no?
Yes. The best part about the foundry, the castings, is that in the value terms, transport is a very minimal cost. But in case of light structures, transport becomes a cost which is considered and it is normally procured locally.
So let's say in the steel plant, what percentage would be heavy structures versus light structures?
I would say about 70% would be heavy and 30% would be light.
So we can still cater the 70% that would be required then?
From here also.
Okay. Thank you so much for your answers. I'll just get back in queue.
Yeah, thank you. We'll take the next question from Mr. Shroot.
Hello.
Yes, sir.
Yes, you're on.
Yes, hi, sir. So, sir, you have enrolled on the Invoice Smart and you've shifted to receivables back funding now. So, sir, how much improvement do we expect in this working capital cycle and the finance costs over the next few quarters?
Avinash, you're on mute.
Am I audible right now?
Yes, perfect.
Hello. Shoji, we have done this, the enrollment for BHL, which we are starting to supply. And we are expecting, we'll be able to scale up. But right now we have not tried it, so anything is not calculatively done. But we'll be able to manage the cash flows very smoothly as far as these platforms communication is given to us. We'll have to check. We have not yet done anything on it, on this thing.
Okay. Also, you have outlined the targeted 40 to 50% CAGR over the next 3 years with a sustained 10% margin. So could you break this down in terms of like which segments will be the biggest contributor, railways, defense, or infrastructure?
Sir, railways will be the biggest because we are adding railway products in both the units. In casting also, we are adding casted railway bogies. And in 2027-28, we will be adding fabricated bogie component. These will make the company switch over from a jobbing to a product line, maybe for 50% of the top line. And that's the reason why we are seeing or visualizing these type of revenues and CAGRs over the 2-3 years time. Railway will be the biggest component.
Yes. Okay. And on the defense and infrastructure casting, we see a normal growth, or do we see some better growth? How is it going to be?
Defense and shipbuilding, yes, there is growth, but shipbuilding, as sir has said, we rightly have re-entered it, and we have been doing that business. But yes, it will not be in the range more than 10%, and there the margins are quite high. We are definitely looking for that angle also. But
Right.
railways, yes, that will be a repetitive business, so we are more inclined on that.
So we are much more confident for the railway sector.
Yes.
Steel, railways, power, that will be the backbone. And as rightly said by Mr. Avinash, 10 to 15% would be defense shipbuilding because of higher profit margins.
Okay. So the last question. Simplex is the world's largest manufacturer of coke oven doors, and is also a top player in like several niche products. So how defensible are these leadership positions, and what barriers to entry protect our market share?
So two things. If you look at any of these tenders from government e-marketplaces and from normal customers, credentials are very important in our kind of industry, in our kind of business. So most of the things would have a prerequisite that what are your credentials for it, and how do you justify your credentials? Fortunately for us, it's an old company, and in most of the products we have the credentials. The largest being the largest market share, largest coke oven manufacturer, coke oven casting door manufacturer in the world has not come by chance. It's basically because we entered into a collaboration with a Japanese company, which was the world leader in that technology. And that was a technical collaboration and a technical, exchange. And we are working with the same designs, and we have improved on that design in the last from 1987 till 2026. It's almost like 40 years. And we have supplied to coke ovens all over the world. So any OEM which is making a coke oven also knows that Simplex Casting can design doors and give the Japanese technology doors which are absolutely state of art. We call them the zero emission air cooled doors. So they are very, very good for not letting even any gas escape out of any harmful gas escape out. So we have a good, what I should say, a lot of visibility because of that product. Simplex Casting has got a lot of visibility because of that product. So I am not worried about protecting my share in coke oven doors, but other niche products, there are other companies also. And we have to be, that's as I told earlier, that we are giving them a basket now. Instead of just center cars and pellet cars, you give us the loading, unloading station, you give us this other areas for the guide rails and those kind of things. So one-stop shop we are trying to become for those niche areas.
Got it, sir. Thank you.
And thank you. We'll take the next question from Mr. Dhaval.
Am I audible, sir?
Yeah, Dhavalji.
Yeah. Sir, I just wanted to understand a few things from Ketanji. Sir, we are hearing a lot of capex signs from various industries, from government, from everybody. Today's newspaper also says that, listed companies capex is at all 13 years high. We understand that. From Ketanji, we just want to understand, since this opportunity is very big and, we are entering a new cycle again, just wanted your views. I understand you have this vision of coming to 500 crores, but looking at the opportunity size today that India is offering, don't we see ourselves even, going well above that also? Just as a big thought that, what can probably stop us, or what can we do better than, we can do, okay, we have done more than 500 crores also. I just want your views on this, looking at this opportunity.
You're perfectly right. Those are the questions that we keep thinking about a lot of times. Because, the kind of what we have built over the last 40, 50 years, just waiting for getting capitalized.
Correct.
If you look at any company in Europe, we could be their manufacturing partner for making of anything that they are wanting, and we have done that for consistently for 10-12 years for a German company. There was a German company called Claudius Peter, which was into cement plant equipment. They were using Simplex castings as their manufacturing base for the equipment that they were making for cement plants all over the world, not for India alone. So those kind of synergies are available to be exploited. If you look at pump castings, if you look at compressor castings, if you look at valve castings, there would be companies in Europe who are looking for the complete pump to be manufactured and sold under their brand name, and we exported to maybe to Malaysia, maybe to Indonesia, maybe to Brazil, wherever. So those kind of possibilities we are yet to work on. So if you are asking me this, I am telling you that, including machine tool industry, including railway, including steel plant equipment, there's a tremendous possibilities once you have a beautiful manufacturing hub, manufacturing facility. China is also winning only because they have state-of-art factories. This is what we are also dreaming that, with this capex, we should be making a better equipment shop, the fabrication shop, and also the foundry to become state-of-art, and then look at those kind of products where we can have a much more value add. Value add will come with design. So we are also thinking of looking at opportunities to take over some company which is into product and then make a product for ourselves with the design component is also with us. So yes, there are chances, there are enough possibilities available. Let us just first, we just come out 2 years, 3 years, last 3 years have been good to us. We just come out. For the next couple of years, consciously, we have taken a decision just to focus on what we are doing, what we are planning. After 2.5 years, once these things are all streamlined, yes, Simplex 3.0 will be slightly different. It will be looking at world view, not at a domestic view, the way we are looking at it now.
Understood. So, sir, just to go on with this, we saw budget there is 10,000 crore allocated to MSME also. So how does it help us in this space, or what do we get from this funds that are allocated? Do we have something for us from the government?
I have not really got into that kind of detail. They said it was for cluster development, the way they have in China. That's what I understood, that a city is there where they make only porcelain, the second city is there where they make toys, somewhere. So these kind of things that they are wanting to. What happens to Bhilai, the cluster, because the asset base that we have is pretty huge. It cannot be duplicated so easily. So if anything happens in this, taken as a cluster of making, we are 160, 170 companies here, which are making equipment for steel plant and power plant. If that kind of cluster gets developed, maybe there will be something we should be looking forward to. Previously, there was a time, maybe about 5, 7, 10 years back, we used to say that anybody who wants to build any fertilizer, refinery, steel plant, cement plant has to come to Bhilai. I don't know whether we are still that cluster and whether government is going to come for that kind of a thing. But I am not that much. I do not have that kind of depth to know what exactly the 10,000 crore is for.
All right. Sir, we hope that you get these details so that you can intimate us about how it will be beneficial to us.
Absolutely.
And one final question is on regards to, I remember we had one order from Musgao dock earlier, and we were somewhere also anticipating few more orders to be lined up for this financial year or even this quarter. Want your update on that, and now since we are shifting gears, I want to understand how this next year plans out for us. Post the fundraise is done, what are the new triggers that we see in our business?
MDL was the only one that we have got. 3 are in pipeline. 3 offers are in pipeline. I am also hoping that in the coming few months, couple of months, we should be getting at least 2 of them. And at the moment, at the cost of repetition, I'm saying for the next 1 year, I just want to stabilize in the areas that we have talked about, like, railway freight car, railway casted bogies, railway fabricated bogies. The whole purpose, the whole thought process behind was that, we should not be too dependent on steel alone.
Correct.
We should have some other product line which are repetitive in nature. So that is why, and railways, we were doing it, and we had the experience of doing it, and we are doing a very good job. 130, 140 crores of revenue from just railways was very good. So we want to go back to that. Fortunately for us, our power sector, which was alive till 2005, 2006, again that has come back. So at the cost of repetition for the next 1.5, 2 years, we just want to concentrate on steel sector opportunities, on the railway sector opportunity, on the power sector opportunity, and keep working on the defense and the shipbuilding side as 10 to 15%.
That's true.
I'm not thinking too many things. Yes, there is something we are looking at, to get into aluminum foundry. We are looking at possibility of taking over some aluminum foundry. Maybe it could be high pressure die casting. We are in talks with some consultants in Germany. Those things, let us see how, when they come out, we'll talk about that. At the moment, it is not the target. If it's viable, feasible, then we'll talk about it.
Understood. Avinash, just one thing to clarify. Of the total fundraise that we are doing, how much are we planning to deploy for the working capital, and what is the current working capital that we have in the business?
We have a CC limit from Kotak of 34 crores, and from the fundraise, we are targeting 25 crores towards capex and 25 towards working capital needs.
Okay, understood. All right. Thank you so much, and all the best, Ketanji. We are seeing some exciting news and announcements from your side. We hope that we have a good year this year.
There will be plenty of news coming up, because I told you most of the orders will get placed now, 26, 27. So it will be a constant thing. That is what we hope for. That is what we expect, sir. So we'll be in touch. And I thank you all for your insightful questions and joining us today. Any other questions?
Yeah.
Thanks, Aman. We'll take the next question from Mr. Khozan.
Yeah.
Lots of echo from your side, Khozan.
Am I audible, sir?
Yeah.
Yeah.
So just a follow-up question to the earlier on the new fundraise that we have done. So we are talking about using 25 crores out of that for capex. So what would be the asset turn that we can expect from that?
What would be, Khozan sir?
Asset turnover from the 25 crore capex that we intend to do from the new fundraise.
I would say at least 3 to 4 times.
Correct.
And so just a very broad level question actually, for all the products and the segments that we cater to, like say railways, defense, shipbuilding and steel, what would be is it possible to quantify the opportunity size over there, and if possible the margin profile for that for each individual segment?
So steel, we will try to restrict it to 40-50%. We can always go for the opportunity in steel could be almost 100%. But we would like to quantify value. We will be restricting ourselves so that we go up the value. We become a little choosy. We will take better profitable orders and do not go for all kinds of orders. But there is a definite possibility in the power sector and railway sector where we are working very diligently now. And that is what we are focusing now for long term. So railway sector, you can kind of put a figure of almost like 20-25%. It should grow in 26-27 from zero almost. And power sector from say about 10-15% to almost like 20-30%. And that is all. I mean, if I want to quantifying the kind of things that are available, it is too much. It's just too much, sir.
Oh.
So we will take what we can chew, because there are consequential damages also, liquidated damages also. And we will chew only what we can, the execution part, the delivery part also we have to see. But order book is not an issue, sir.
Sure. And sir, was there any provision for the new labor code? I mean, I was not able to kind of individually locate that number. Yeah, we have done it, sir, and that is very, very minuscule to, it will make not an impact. Oh. Yeah. Thanks. Yeah, that's it.
Thank you. We'll take the next question from Mr. Charchit.
Hi, sir. Am I audible?
Yeah.
Sir, I have a question on our Dhanush project. So, like, what kind of revenue do we have from the Dhanush, and what kind of margins do we enjoy in this project?
Dhanush, we are still working as far as just machining one of the assemblies that they have given us. Revenues are in the terms is very low at the moment, but we are trying to build on it. In couple of years' time, it should be in the range of maybe 10 to 15 crores.
Okay. So, like, earlier you gave the guidance of like 200 plus crores in FY26. So, like, till now we have done 150. So, are we intact on that?
Yeah.
And like, what kind of revenue like we can expect in Q4?
I think Avinash, you can confirm.
We have done last year Q4 67 crores, sir, and it will be better than that.
And with the same EBITDA margin of 15?
Yeah.
Okay, sir. Thank you.
Thank you. We'll take a follow-up question from Mr. Penny.
Yeah, thank you for the follow-up. So I was wondering, in terms of the margins, I understand that you want to be more choosy and become a solution provider. So, but what margin percentage are you expecting as a management to choose, or let's say bid for? In what margins can we forecast in terms of going forward? What is that kind of this?
Say, for example, like in our market, we make customized products. The margin percentage when I do in cocoa doors is much higher compared to when I do other castings. Because there is an element of design involved, and there is some guarantees involved. So there is a higher margin to that. And there are fewer players, because Simplex is one of those kind of monopolistic players there. So I get better margins. Say that, I'll be choosy. I'll be looking at first filling up my order book with those kind of orders where I get a slightly better margin compared to being in the normal marketplace and, be competing with so many other companies. And like, if you look at most of the PSUs, they have gone for GEM portal. So I am looking at more where there is a credential oriented and where we have better credentials than others, and there is the competition is between a fewer players.
Understood. But you already have, let's say, a specific idea in mind on what the composition you want as personally for the company. So just wondering, in terms of with the ideal composition you want, what are the margins you would like to receive from the?
I am targeting at least couple of percentage more than this financial year.
Are you talking in terms of PAT, or are you talking in terms of EBITDA? Like, I understand overall it can be the same thing, but yeah.
EBITDA.
Got it. And one more question regarding the putting up the capacities. How long do you think? What is the timeline of putting up these new capacities?
So for the casted bogies, we have already done that. It's already in place now. For the fabricated bogies, this 25, what we are looking at, should take us about 6 to 8 months, sir.
Understood. And one last question regarding working capital limit. I understand 25 crores is there, but the thing is, we have very long working capital cycles, right? Especially because it takes so long to build it, because of inventory and all of that. I was wondering, how are we planning on continuing our liquidity, especially with the growth we want, 50% CAGR, and with the existing inventory cycle, we'll need a lot more working capital than the 25 itself. So what is the plan, especially because we already been through this once? how is the management prepared and what is it doing specifically?
What we have done, sir, the selection of products that we discussed was railway and power sector in equipment. That was also based on what will be, one of the questions earlier was, what did you learn from the mistakes of 2019? So these are the things while we were selecting the products, charting our vision for Simplex 2.0. Railway, sir, consistently pays, that's been our experience, and that's been going on even now in the last 6 years that we followed up. The day they receive, within 15 days, the payment comes. So this 40, 50, 60, whatever we are doing for the casted or the fabricated bogies in the next financial year, the payment cycle is much shorter compared to when I look at the steel industry, which is like 30 to 45 days. Second
What about the power sector?
Yeah, I'm coming to that. Power sector, as Mr. Avinash said, that he has not tried. Number one, we are part of MSME, so most of the PSUs have to give us in 45 days. But with INCRED, we expect that to be even shorter by 15 days. So within a month, because finally the bill has to go up to the billing section. They have to put it on the computer, then only INCRED is going to start working from there. So the 15-20 days period of transport and receiving and all that. So we expect that we will be shortening that cycle by another 15 days to 1 month.
I'm sorry, but I'm not familiar with what INCRED is.
Without INCRED.
INCRED or InvoiceSmart or RXIL or M1 Exchange.
Normally for power sector, it's 2 months, 2.5 months.
Okay.
With this facility of INCRED for BHL available, what Mr. Avinash was saying, we should be in a position to shorten it by at least 15-20 days, maybe a little more.
And for the inventory, it's going to be similar to all of them, right?
Both the inventories, also the products have been selected, which are very fast moving compared to the other equipments that we will keep making, and we will keep continuing. These two items, specifically power sector and railways, have a very small gestation time, in the small time for that they are with us. They are fast moving.
So even timeline of production is also shorter with the new products?
For these two products, yes.
Okay, so got it. That's it from my side. Thank you so much.
So, but that is a very interesting question. But good that you could bring it out that why these two products that Simplex has selected, and why are we saying that for the next couple of years, at least 1.5 to 2 years, we want to focus on that. It has been brought up so that we could explain our position and our thinking on that for everybody.
Understood. Sorry, just follow-up question regarding that. So in terms of working capital, what working capital are we going to expect from going forward from 26-27? The number of days, I mean.
Avinash,
We'll be experiencing it, sir. We'll try to bring it down to maybe 30 days or 45 days within this thing.
Inventory,
for these products.
For these products, that definitely 30-45 days. But the balance would be so average.
We are coming out from a jobbing to 50% at least repetitive one. So काफी तो control हो जाएगा. Not wholly.
Balance will be there.
Yes, balance will be there.
Yeah. But the blended level for the next 2 years, what do you expect?
My expectation would be on outer side 3 months.
Okay, 90 days basically.
My expectation.
Yeah.
Understood. So, but the thing is, the quarter's revenue will be stuck in working capital, right? Will we have enough growth, enough cash sufficient to grow that 50%? Is still my little doubt on that part of it. Okay. Thank you.
Thank you, Praneeth. Dear participants, that marks our last question for the Q&A session. I would like to pass it on to Mr. Ketan for any closing comments or closing remarks for our investors and what's next in Simplex 2.0.
As I always say that, talking to people like all the investors, it always is a very insightful conversation, and I also learn every time a few things, and that is why I love discussing and meeting and connecting with all of you. So I thank you very, very, thank you from really, it was really nice conversation. And with an improving balance sheet, we are very sure in what we just discussed, that railway business and power business, and with the capex plans that we have and the things that we are thinking, I'm very, very sure we are that we will only rise from here. We'll become better and better in all fronts. That is what I am hoping, planning, and wishing. Thank you so much.
Thank you to the management of Simplex for being a part with us on a Tuesday evening. Thank you to the participants for taking out the time and attending our conference call. You may all now disconnect your lines. Thank you so much, and see you in the next quarter.
Thank you so much.